Hello and welcome, everyone. Let's take a look at today's market landscape. Starting with Wall Street overnight, the headline numbers were essentially flat. The Nasdaq closed at 25,373, the S&P 500 at 7,489, and the Dow at 52,485, all virtually unchanged from Thursday. But beneath that calm surface, there was real movement. Nvidia rose about 2% to close at 200.75, holding firmly above the 200 mark, which tells us AI chips remain the direction global capital trusts the most. Tesla also edged up slightly. On the flip side, Bitcoin-related plays and the ARK Innovation ETF pulled back anywhere from 2 to 4%. That tells us risk appetite is not broadly spreading across the market. It is highly concentrated in AI compute hardware. A steady close on Wall Street provides a neutral to slightly positive external environment for A shares, and Nvidia's strength creates a direct read-through to our own AI compute supply chain. Now let's check the global macro thermometer. The 10-year Treasury yield sits at 4.74%, up from 4.62% over the past week. Elevated rates continue to cap the valuation ceiling for global risk assets, and the liquidity constraint has not been lifted. The VIX, or fear gauge, is at 15.99, down sharply from above 20 a week ago, a drop of over 20%. It is now at the lower end of the normal 15 to 25 range. Panic has clearly retreated, but we are not yet in greed territory. The dollar index has broken below the key 100 level, now at 99.8. A weaker dollar provides valuation support for emerging market assets and eases pressure on the renminbi. Crude oil is holding above $84, which is a cost pressure downstream but a profit tailwind for the energy sector. Spot gold is above $4,100, up 1.4% in the last 24 hours, as safe haven demand and the weak dollar narrative reinforce each other. Taken together, the global market is in a mild risk-on state. The logic chain is clear, a sharply lower VIX plus a dollar break below 100 is pushing risk appetite higher. But the 4.74% 10-year yield forms a valuation ceiling that caps the slope of this rally. The failure conditions to watch are simple. If the 10-year yield breaks above 4.85%, or the VIX climbs back above 18, this call flips to risk off, and A-share strategy should reduce exposure accordingly. On the currency front, the onshore and offshore renminbi are both stable around 6.75, with very narrow trading ranges over the past week. With the dollar weakening, depreciation pressure on the yuan has clearly eased, which is friendly for foreign capital flows into A shares. On US-China trade, we have two verified developments. First, the new US tariffs on Chinese goods took effect on August 1, with 100% on electric vehicles, 25% on lithium-ion batteries, and 50% on semiconductors and solar cells. This is known bad news that has now landed. Second, the head of the China Council for the Promotion of International Trade is leading a business delegation to the U.S., holding more than 10 meetings with American institutions and companies. That sends a signal of easing tensions, which is a marginal positive. A shares are closed today, with the next session on Monday, August 3. My opening call is for a flat to slightly higher open, supported by three factors: steady U.S. stocks, a low VIX, and a stable renminbi. The headwinds are the 4.74% Treasury yield and potential sentiment shock in the export chain after the tariffs took effect. If the offshore yuan weakens past 6.77, or A50 futures turn lower in pre-market trading, then the call changes to a lower open. Looking at the session ahead, the index direction is likely to be range-bound with an upward bias, but be careful of a spike and reverse pattern. Last Friday, the Chinext board surged over 3%, the Shenzhen component rose over 2%, but the Shanghai composite only gained 0.7%, and the SSE 50 was slightly negative. That growth versus blue-chip divergence is significant. It tells us capital is concentrated in tech and growth names, not broad-based buying. With steady overseas markets and a weak dollar, there is momentum for a higher open on Monday. But after the Chinex's consecutive gains, profit-taking pressure is building, and the probability of a fade after an initial pop is not low. If the Shanghai index breaks below 3,800 at the open and the Chi-Next gaps down more than 1%, then the directional call flips to down. Two main lines deserve attention. The first is AI compute hardware and semiconductor materials. NVIDIA's gain on Friday provides the U.S. market read-through. Our supply chain radar shows semiconductor materials name AXTI up over 26% in 5 days, and Edge AI chip name AMBA also up 26% in 5 days. Indium phosphide compound semiconductor substrates are directly tied to AI optical communication demand, and this is the most likely area for capital to focus on. The second line is rare earths and critical minerals. Rare earth commitments are an explicit demand from the U.S. side in trade discussions, so the sector has policy catalyst expectations. On the avoidance side, new energy vehicles and solar export chains must be watched carefully. The 100% EV tariff and 50% solar tariff are now in effect, directly damaging the export thesis. Even if these stocks bounce short-term, participation is not recommended. For northbound capital flows, the probability of net inflows is higher. The dollar index at 99.8, the renminbi at 6.75, and the VIX at 15.99 all point to improving risk appetite among foreign investors. The confirmation signal is this: if northbound net inflows exceed 3 billion yuan in the first hour of trading, the call is confirmed. If net outflows exceed 2 billion in the first hour, then the call is wrong and the sustainability of the AI compute theme needs to be reassessed. Now for individual names. On the opportunity list, AXTI, the semiconductor materials player focused on indium phosphide substrates. The forecast is high-level consolidation or a spike and reverse, with 55% probability, over a 1 to 3 day window. The trigger condition is that the AI data center optical communication demand logic continues and the stock holds above its 5-day moving average. The invalidation condition is a break below recent lows or further deterioration in market conditions. Position discipline: wait for a pullback, test with a small position, and do not chase strength. For holdings diagnosis, AEHR, the CoAS packaging and testing equipment name. The forecast is relative resilience, with 58% probability, over a 1 to 5 day window. Monthly gain is 14%, catch-up progress is nearly 79%, and the stock is well above its 200-day moving average. The AI packaging bottleneck logic remains intact. The invalidation condition is a break below the 200-day line or a falsified catch-up thesis. Position discipline: hold, do not add. For risk avoidance, POET, the optical chip name. The forecast favors downside risk at 65% probability, over a 1 to 5 day window. Monthly performance is very weak, it has broken below its 200-day moving average, and short crowding is elevated at 0.55, making it vulnerable to short attacks in a correction. Invalidation would require reclaiming key moving averages with a significant drop in short crowding. Position discipline: cut immediately, do not participate in bounces. Also on the avoidance list are VICR and AKTS, with AKTS down over 30% on the month with extremely high short crowding. That risk is unmanageable. Here is today's one-sentence core call. Weak dollar, low VIX, stable renminbi. The risk-on window continues. AI compute and semiconductor materials have the edge. But the 4.74% Treasury yield caps the upside, so chasing strength is dangerous. Today's probability assessment: up 40%, range-bound 40%, down 20%. That is all for today. Thank you for watching, and we will see you next time.